Welcome to Chapter 5, Internal Control and Cash. Internal control has really come to the forefront of businesses within the last 10 years or so, based on some businesses that went bankrupt, caused investors to lose huge amounts of money, such as Enron, MCI WorldCom, Adelphia, and a host of others. So internal control is really been under the microscope to help investors be able to have faith in the financial statements in which they have received. Internal control is a company-wide process that seeks to improve a company's operations and its financial reporting. Among other things, internal control helps a company protect its assets. Internal control is the system of policies and procedures that a company puts in place to provide reasonable assurance that, first of all, the company's operations are effective and efficient, that the company's financial reporting is reliable, and the company is complying with applicable laws and regulations. This is very important to those of us who want to give our money to companies to make sure that at some point in the future we will get our money back. Internal control report needs to include the following. We recognize that internal control affects a company's success or failure. Section 404 of SOX, Sarbanes-Oxley, contains several new requirements for what we call publicly traded companies. Those are those companies that are trading on the stock exchange regarding internal control. One of the most important requirements is that corporations include in their annual reports to shareholders an internal control report containing the following two items. One is a statement that is management's responsibility to establish and maintain adequate internal control structure and procedures for financial reporting. An assessment of the effectiveness of internal control structure and procedures for financial reporting for the most recent year. This was a change due to all of the companies that left the shareholders holding the bag. In addition to requiring an internal control report, SOX, also known as Sarbanes-Oxley, in 2002, there was two senators who came together to put together this bill, perhaps the last time maybe Washington has worked together, to come up with a bill and a set of regulations that would bring back the purity to the financial statements to the best that they could. So it requires management to obtain an annual audit of its internal control structure and its assessment. In other words, SOX requires an independent third-party evaluation of management's assessment. This evaluation is performed by the public accounting firm conducting the company's financial audit. Thus, management must take responsibility as well as provide an assessment of internal control. Here's an example of what an internal control report looks like. The highlighted sections that you see here, these highlighted sections that you see here, show Domino's management. Number 1 takes responsibility for its internal control. Management takes responsibility. It also states in number 2 that it has conducted an evaluation of the effectiveness of its internal control and reporting. And it concludes in number 3 that its internal control is in fact effective. The highlighted portion of the audit report shows that the audit firms agree. That's down here, shows that the audit firm agrees. Based on its audit of Domino's internal controls, PricewaterhouseCoopers' opinion is that Domino's maintained effective internal control over financial reporting during the most recent period. This is the opinion that management wants to get. You want what we call it is in our opinion. If they come back and they state that there are some issues with the internal control that have to be fixed, companies don't like to see that, nor do investors want to see that. They want to see what we call a very clean report. Over here you see SOX, Sarbanes-Oxley. Sarbanes-Oxley requires both management report on internal controls and annual audit of the company's internal control structure, by a third party. COSO presents a framework to that internal control structure, and that framework looks like this. Here are what we call the components of internal control. We have our control environment, risk assessment, control activities, information and communication, and last but not least, monitoring. And so we're going to go through each of these and we're going to take a look at what this means. So first off, we have the control environment. The control environment is effectively the foundation for all other components of internal control. It lays our foundation. It is the atmosphere in which the members of an organization conduct their activities and carry out their responsibilities. It's an atmosphere. Okay? We say that that environment or that attitude for things being done by the letter of the law or the rules or following GAP and those guidelines say that this environment or this atmosphere comes down from the top. It is a tops down from the CEO and the board of directors down to the employees. We have that affect internal control or infect the control environment. One is overall integrity and ethical values of personnel, management's philosophy and operating style, assignment of authority and responsibility, and general structure of the organization. One of the most important of these is, in fact, the overall integrity and ethical values of the personnel. And the reason that is if your CEO has integrity all the way down to the warehouse guy, then you won't have inventory leave out the door. You won't have bad backroom deals. You've got a company with ethical values. And you are going to take a look at a company called Enron. You're going to watch a short video over the next couple weeks. And you're going to see and take a look at a company where from the tops down, they lacked that overall integrity and ethical values. Each of these factors contribute to the overall corporate culture, within and which internal control operates. Without a sound control environment, the remaining elements of internal control can and will suffer. Risk assessment is the identification and analysis of the risks that threaten the achievement of organizational objectives. Organizational risk can arise from both external and internal sources. External sources might include new competitors, changing customer expectations, or even natural catastrophes. Internal sources might include an inadequate workforce training, like new auditors that come on and you put them on a very difficult case thinking that they're going to be able to find their way through very smart companies' records. Errors in financial reporting of activities, or theft of assets by employees. So what you have to do is you have to take a look at what are our risks. So let's say we're Best Buy, and we know that there is large risk of our inventory leaving the building, whether it be from a potential customer, from employees, and we have to put processes in place that actually control our inventory. You have all seen those inventory processes, and we'll go over some of those here in a minute. After we identify there is in fact a risk, we then go through and create a process of risk analysis. First of all, we need to estimate the significance of the risk. For instance, in the Best Buy example, the fact that they have inventory, lots of it, that might not make it through the cash register. Assess the likelihood of the risk occurring. They have a lot of inventory, small pieces, large pieces, and there's lots of different creative ways that they can get out of the building. And we need to then consider what action should be taken to manage the risk. And so what they've done in Best Buy is they've created, plastic tags, small pieces of paper that you bring up to the checkout stand, and then they get you your iPod out of a cage. Those are all inventory risk management tools, as well as we've all gone and gotten a piece of clothing with the big plastic thing on or the ink things. Those are all risk processes. Even Burger King, when they say, if we don't give you a receipt, the meal is on us. And that's because the guy could be ordering your burger and giving it to you, taking your money and putting it in the pocket and never running it through the cash register. The only way you can get a cash register receipt is if you ring it up. And so therefore, they have in fact put in an internal control. That, what I've just described, also contributes to the actual control activities that we will be doing. And we'll be talking about that next. Control activities are the policies and procedures management establishes to address the risks that might prevent the organization from achieving its objectives. So what that means is the objectives for Best Buy is to sell inventory. And therefore, if they don't sell the inventory and the inventory leaves without being sold, them getting money for it, then they are losing money, and that threatens the organizational objective of, in fact, making a profit. There are critical factors in the next set of slides in which to help achieve good internal control. Although specific control activities vary widely across organizations, they generally fall into one of the several categories we have here. First of all, companies need to establish responsibility. That means each person in a particular job, in my company, HP, we call those individual contributors, we establish a responsibility for them. We then maintain adequate documentation. Segregation of duties. What that means is the person who collects the accounts receivable, for instance, also doesn't deposit it in the bank, write checks, or do a bank reconciliation. You segregate the cash duties. In fact, if you're taking it, you shouldn't be the person counting it. Physical security, the examples of Best Buy that I gave you and us purchasing clothing where we have to bring the paper or the plastic tags or the cage, that's physical security. And then independent verification. How many of you have gone and gotten a return or a refund? Most often when that case happens, they call over a manager who has a key who unlocks the register to get a refund or has to look at it and sign a receipt. That is an independent verification of that return as well as adequate documentation. So when you set up an internal control process, you want to keep in mind that a person has a responsibility. You tell them what those are. They need to be measurable. That you provide adequate documentation. In my company, I have to do that anytime I ask for an expedite, no matter how much it is, from 50 cents up to $1,000. You segregate the duties, so therefore you can have people doing different things. You have physical security, and you have independent verification. This all is actually awesome when you have these good factors for internal control. However, anytime you have two or more people get together, we call that collusion. Then effectively, any of these factors or internal control can in fact be out the window. Because they could have separate duties, but if they team up to rip off the company, then that in fact's out the door. So the major concern with internal control, as we'll talk about in a few minutes, is in fact humans. The next stage in our process is information and communication, required for the open flow of relevant information throughout the organization. So what that means is information must be captured and communicated in a form and a time frame that enables employees to complete their responsibilities. This requires information systems that produce relevant and reliable reports. It also requires both upward and downward lines of communication. Management must communicate with employees, and employees must communicate with managers. In addition to information we also have monitoring. Monitoring refers to the assessment of the quality of an organization's internal control. And what that means is we need to be able to monitor what is happening and being able to change if we aren't seeing the results that we want. And two approaches to monitoring. One is ongoing activities. For example, in his reoccurring daily responsibilities, a supervisor can check for evidence that a control activity is functioning properly. The second is through separate evaluation. The audit of internal controls required by SOX is an example of separate evaluation. In both ways, the purpose of monitoring is to continuously improve internal control. Said and done, there are, as I had mentioned a couple slides ago, a couple of limitations to internal control. Regardless of how well internal control is designed within an organization, it can provide only reasonable assurance that a company is meeting its objectives. Internal control systems are limited in their effectiveness, number one, because of the human element, and then secondly, the cost-benefit analysis. You may have inventory that's leaving the building, but it might be too expensive to go ahead and put a process in place to stop that from happening. So you always have to do the cost-benefit analysis, what might circumvent a better internal control system. So the two limitations are the human element, known as collusion, and cost-benefit analysis. Now we're going to go ahead and move into 2 or 3 of the numerical ways to help with internal control limits.